Shreyas, Himanshu this side.
Hi there.
I hope I'm audible. Yeah. So actually, I'm a system trader and pretty new. Okay, in the system trading thing. I just started last September. Okay, and right now, I am a salaried person, and all my expenses are covered with the salary. Okay. So I have like two systems at my disposal. One is like 1% drawdown system with 24% annual return. Another one is 5% drawdown with 70% annual return. Okay, so the thing is, I started with the 5% and 70% thing, and I started in September, and September, October, November went very well, and then December came where I hit the maximum drawdown. I got scared and I switched to that 1% drawdown system. As soon as I switched to that 1% drawdown system, that 5% covered the drawdown in like 20 days. Okay. So what would you do in this scenario? Like, which first of all, which system would you use? Would you like accept or start doing that system if you are a salaried person and all your expenses are covered by the with the salary?
Hi. So couple of things here. Okay. So firstly, I'm not fully systematic, but I'm actually not even. So I don't qualify as system trader. But I'll put it this way: if you have everyone's risk appetite is different, right? So you are saying you're a salaried person, so you don't need to take out money from your trading account. Great. So that means that your risk appetite is relatively higher. It's not about what I would do. See, that's why I keep coming back to this. It's about trading is very personal. You have met the max drawdown and you've cut risk. Good behavior. I agree with that. Great. Now, I would do the exact same thing. Now, as you are slowly recovering from your drawdown and heading back towards equity high, you can maybe come up with a balance. I don't know if it's just you have to go either only 1% or only the 5% type style, or you can sort of have a balance between the two. Arrive at what risk level is comfortable for you, right? It's different for all. For somebody looking at mark to market switch 30,000 or 50,000. Sorry, there's some disturbance. Yeah. For somebody watching a tick of 1 lakh mark to market per tick or like 2 lakh mark to market per tick, they might be comfortable with. But with somebody, they might not be okay with 5,000. So you can't come up with, or even in a percentage basis, somebody might be okay risking 1.5%, 2% in a day, or some people even maybe 2%, 3%, because they're making accordingly 6%, 7. That's their risk appetite. It's a personal thing. There's no hard and fast. But one thing that you pointed out rightly is when you're losing money, always start cutting risk. See, there are two kinds of people. Okay, people who cut risk when they're losing money, and people who add risk when they're losing money. The second type, no, will always sort of quickly come back, right? Because most of the time, when you're entering a trade, when you're already losing, essentially averaging the equity curve, let's say, you have a higher chance of bouncing back quicker, but you have an equal chance of falling even faster, right? And that goes up exponentially. So I don't know. You will have to come up with the answer to this yourself. The fact that you're saying that I'm a salaried employed shows that you're saying that I have a relatively larger risk appetite because I'm not dependent on the market for my day-to-day thing. Cool. So you come up with, okay, how much am I willing to lose? How much am I not? And accordingly, that can be done.
Yeah, but the thing is actually that 5% drawdown actually scared me because my salary I had like saved for the past 12 years, and I saw my like initial 5 months salary going into the drawdown. Okay, so that's what scared me, and I am again planning to switch back to the original one because the
One more
drawdown
thing, right? One more thing. Look, I'll tell you what. When you get afraid, when you get scared, when you have not, when your position size is too large, don't think just because you have margin you can use it. Okay, you need to earn the right to use the margin that you have. You have saved up over X amount of time. You don't have the right to trade on that margin. If you have saved up over a few years, you have not earned the right to trade on that margin. When you don't, you're saying you just started in September and you're already trading with a substantial portion of your life savings. That would be wrong, and that's why you're feeling afraid also. The better way to do it is, even if you have, let's say, 10 lakhs of margin, trade only with 2 lakhs of it. Right? As you get comfortable with that, as you've seen the ups and downs of that, then move to the next, then move to the next, add size, add size, add size. Fear in markets is always particular derivative of your position size. If you are overexposed as per your own risk appetite, you will feel fear. So get rid of that aspect. Cut down size. The best way to deal with fear is cut size. When you are looking at half the market of what you were looking at yesterday, both positive and negative, you will feel much more comfortable. You will have time to analyze, okay, what is working, what is not working, should I work with this system or not? There's some background noise. Yeah. So that's my take on it. If you're feeling afraid, the first reaction to feeling afraid is cut size, right?
Okay,
So
thank you so
yeah,
much.